$10 trillion. That's how much one company manages. More than the GDP of every country on Earth except the United States and China. But here's the part that should stop you. BlackRock doesn't own that money. You do. Your retirement account, your pension, your index fund, your 401k, that's all your money. But when it's time to vote those shares, when corporations decide who sits on the board, whether to approve a merger, how much to pay executives, you don't vote, BlackRock does. Millions of people's money, one company's voice. This isn't conspiracy, this is market structure. And it's built on 5 mechanisms most people have never heard explained. Let me show you exactly how one company ended up controlling ownership across the entire economy, without technically owning anything at all. First, you need to understand what BlackRock actually is. Most people assume it's a bank. It's not. Banks take your deposits and lend them out. BlackRock doesn't do that. BlackRock is an asset manager. Pension funds, sovereign wealth funds, insurance companies, university endowments, they all hand BlackRock their money to invest. BlackRock charges a fee, sometimes as low as 0.03%, and invests according to each client's strategy. At that fee, you'd think there's no money in it, but multiply 0.03% by $10 trillion. That's the scale. Now here's how BlackRock got here, and why the founder's origin story matters. 1986, First Boston. A bond trader named Larry Fink is one of the rising stars on Wall Street. He's pioneering mortgage-backed securities, bundling home loans into tradable products. It's working. He's making the firm hundreds of millions. Then interest rates move the wrong way. One quarter, Fink's bets go bad. He loses $100 million. For the firm. In weeks. He's out. But Fink learned something from that failure that will shape everything that comes next. The problem wasn't the bet. The problem was that nobody, not him, not the firm, not anyone on Wall Street, truly understood the risk in those products. Risk management wasn't a priority. It was an afterthought. Fink decides, if he ever builds something again, risk measurement will be the foundation, not an afterthought, the entire point. 2 years later, 1988, he starts BlackRock with 7 partners and one obsession. They build a system to measure risk across every type of asset: bonds, mortgages, derivatives, anything that could blow up, they want to see it coming. They call the system Aladdin, Asset, Liability, Debt, and Derivative Investment Network. We'll come back to Aladdin. It becomes the most important piece of this story. For now, understand that BlackRock starts as a risk management company that happens to manage money. Not a bank, not a hedge fund, a machine for seeing what others can't. For the first 20 years, BlackRock grows steadily, mostly managing money for institutions. Then comes 2009. The financial crisis has just torn through Wall Street. Banks are collapsing, the government is scrambling, and BlackRock makes an acquisition that changes everything. They buy Barclays Global Investors for $13.5 billion. The deal brings one asset that matters more than anything else: iShares. iShares is the world's largest platform for exchange-traded funds, ETFs. And this is where the first mechanism clicks into place. Mechanism 1, the index fund trap. Here's how index funds work. Instead of paying a fund manager to pick stocks, to guess which companies will outperform, you just buy a fund that owns everything in an index: the S&P 500, the total stock market, the global market. No guessing, no overpaid managers, low fees. And here's the thing, it works. Over any 20-year period, most active fund managers fail to beat the simple index. So money floods into index funds. In 2000, index funds held about 5% of U.S. stock market assets. By 2024, it's over 50%. Every year, hundreds of billions of dollars flow out of actively managed funds and into passive index funds. The logic is irresistible. Why pay more for worse results? But here's what nobody explained to the people making that rational choice. When you buy an index fund, you're not buying stocks. You're buying a claim to stocks. The fund owns the shares. The fund votes the shares. And 3 companies manage the vast majority of index fund assets: BlackRock, Vanguard, State Street. Together, they're called the Big Three. Between them, they manage over $22 trillion. And here's the number that matters. In the average S&P 500 company, the Big Three together own roughly 20 to 25% of all shares. Not because they bought those companies, because you did, through your retirement account. And they vote it. This brings us to the second mechanism, the one that turns passive investing into active power. Mechanism 2, the voting mechanism. Every share of stock comes with a vote. If a company wants to elect board members, approve a merger, change executive pay, shareholders vote. In theory, this is corporate democracy. Owners have a say in how the company is run. In practice, most retail investors never vote. They don't have time. They don't understand the issues. They throw the proxy ballot in the trash. But when your money is in an index fund, you don't even get the ballot. BlackRock gets it. BlackRock has a team called Investment Stewardship, about 70 people. Their job? Vote on every proxy ballot for every company in every BlackRock fund. Thousands of companies, tens of thousands of votes per year. 70 people. Voting shares worth trillions of dollars. Here's why this matters. In most shareholder votes, turnout is low. Many shareholders don't participate at all. But BlackRock always votes. That means BlackRock's 7% stake often carries the weight of a much larger block. When only 60% of shares vote, owning 7% means you control. Nearly 12% of the votes that actually count. And BlackRock doesn't just vote, they engage. Before the vote happens, BlackRock meets with company management. They communicate their expectations. They signal what they want to see. Companies listen. Because if BlackRock votes against your board, you might lose your seat. If BlackRock opposes your merger, it might fail. Every year, BlackRock's CEO, Larry Fink, sends a letter to the CEOs of every major company BlackRock invests in. These letters outline what BlackRock expects on climate, on governance, on long-term strategy. No other investor has this kind of reach. One letter, thousands of CEOs. This isn't ownership in the traditional sense. It's something new. BlackRock controls the voting power of ownership without the legal responsibilities of being an owner. They can pressure companies without being liable for what those companies do. They have the power of an owner with the legal distance of a service provider. Now, here's what makes this different from the monopolies of the past. When Standard Oil controlled 91% of American oil refining, the problem was obvious. One company, one industry, total control. They could set prices, crush competitors, extract maximum profit. The government broke them up. When J.P. Morgan's interlocking directorates controlled railroads, steel, shipping, and banking, the problem was visible. Morgan's partners sat on dozens of boards. The web of control was documented. Congress investigated. New laws banned interlocking directorates. The monopoly was dismantled because people could see it. BlackRock's structure is different. BlackRock doesn't own 91% of one industry. They own 7% of every industry. There's no law against one company owning 7% of everything. It's not technically a monopoly. It's diversified investment. That's the genius. A monopoly that's legal because nobody wrote a law imagining it could exist. And this brings us to the third mechanism, the one that turns BlackRock from a large asset manager into something closer to infrastructure. Mechanism 3, Aladdin. Remember the system Larry Fink built after his failure at First Boston? The risk management platform that was supposed to see what others couldn't? Aladdin grew. Today, Aladdin doesn't just manage risk for BlackRock's $10 trillion. It manages risk for an additional $11 trillion belonging to other institutions. $21 trillion on one system. Pension funds use Aladdin. Insurance companies use Aladdin. Banks use Aladdin. Sovereign wealth funds use Aladdin. Even BlackRock's competitors use Aladdin. Vanguard, BlackRock's biggest rival, uses Aladdin. Here's what Aladdin actually does. It runs continuous risk analysis on every position in a portfolio. It stress tests holdings against thousands of scenarios. It identifies correlations that humans would miss. If you manage billions of dollars, you need this kind of analysis. You can build it yourself, which costs hundreds of millions and takes years, or you can license Aladdin. Most choose Aladdin. And once you're on Aladdin, you're unlikely to leave. The switching costs are enormous. Your entire operation runs through it. Your teams are trained on it. Your risk reports depend on it. This means BlackRock sees things no one else can see. When markets get stressed, BlackRock knows, through Aladdin, how trillions of dollars are positioned, what institutions are exposed, where the risks are concentrated. No government regulator has this view. No central bank has this view. Only BlackRock. This information advantage is impossible to measure, and it's perfectly legal. BlackRock isn't trading on insider information, they're just seeing the system more clearly than anyone else. And when crises hit, this is exactly why governments call BlackRock. Which brings us to the fourth mechanism. Mechanism 4, government integration. March 2020. COVID-19 is shutting down the global economy. Credit markets are freezing. Companies can't borrow. The financial system is seizing up. The Federal Reserve announces emergency action. They're going to buy corporate bonds for the first time in history. But the Fed doesn't have the infrastructure to do this. They don't buy corporate bonds. They've never done it. So they hire someone who does. BlackRock. BlackRock runs the Fed's emergency bond buying program. They advise on what to buy, how much, when. They're buying bonds for the government while simultaneously managing trillions in private money that benefits from those same purchases. Player and referee, advisor and beneficiary. This isn't the first time. In 2008, when the Fed needed to figure out what toxic assets were worth, they called BlackRock. BlackRock valued the assets the government was considering buying. They also managed money for clients who would benefit from knowing what the government was about to buy. In 2019, the European Central Bank hired BlackRock to advise on bank stress tests. BlackRock, which manages money across European markets, telling the ECB which banks are safe. There's a pattern here. When things are stable, BlackRock is the largest asset manager. When things break, BlackRock becomes essential infrastructure. Too big to fail is about banks. BlackRock is something different, too embedded to remove. Now we arrive at the fifth mechanism, and this is the one researchers are starting to worry about most. Mechanism 5, the common ownership problem. Remember, BlackRock doesn't operate alone. The big three, BlackRock, Vanguard, State Street, together own about 20 to 25% of most large companies. And here's what makes that strange. They own 20% of Delta, and United, and American, and Southwest. They own 20% of every major airline, and every major bank, and every major telecom, and every major pharma company. These companies are supposed to compete with each other, but they share the same largest owners. Economists have started asking, what happens when the same investors own all the competitors in an industry? The answer isn't obvious, but it's not good. Think about it from the company's perspective. If BlackRock owns Delta and United, does BlackRock want them to compete fiercely for your business? Price wars hurt both companies. Market share battles destroy profits. What if, instead, both companies just don't compete that hard? Prices stay high, profits stay high. BlackRock's holdings in both companies stay valuable. Nobody has to say this out loud. Nobody has to break the law. The incentive is structural. It's in the ownership itself. Researchers studying airline prices found that routes where common ownership is highest have prices 3 to 7% higher than routes where it isn't. That's not proof of conspiracy. It's not illegal coordination. It's the market responding to incentives. And the incentives come from the ownership structure. This applies across the economy. Banks where common ownership is higher charge slightly higher fees. Pharmaceutical companies where common ownership is higher compete slightly less on drug prices. None of this is dramatic. It's not a cartel meeting in a smoke-filled room. It's a quiet, structural drag on competition. A few percent here, a few percent there. Multiply that across the entire economy. This is the part that worries economists more than BlackRock's size alone. It's not that one company has too much power. It's that the structure of ownership might be quietly making the whole economy less competitive. So where are we inside this pattern? Let me show you what the numbers project. In 2000, index funds held 5% of U.S. stock market assets. In 2024, it's over 50%. By 2030, analysts project it could reach 70%. At 70%, the big three wouldn't just be the largest shareholders in most companies. They would approach outright voting majorities, not individually, but collectively. The index fund trap accelerates. Every year, money flows out of active funds and into passive. The logic remains irresistible. Why pay more for worse returns? But every dollar that flows in concentrates voting power further. The thing that's rational for each individual investor creates something irrational at the system level. A machine that nobody designed, that nobody voted for, that nobody can easily stop. Because who would stop it? Regulators don't have the tools. Antitrust law was written for Standard Oil, for companies that own too much of one thing. There's no law against owning a little bit of everything. Politicians don't have the knowledge. This isn't a culture war issue. It doesn't fit on a bumper sticker. It's market structure. It's boring until you understand it. Then it's unsettling. And the companies being held don't want it to change. Higher profits, less competition. Why would they complain? So the machine keeps running. And BlackRock keeps growing. Here's what this means for you. Your retirement savings probably flow through BlackRock. If you have a 401k, a pension, or an index fund, some of your money almost certainly passes through the big three. You've become part of the machine without choosing to be. The fees you pay are low. The returns are decent. On paper, it's a good deal. But you've traded your ownership rights for convenience, and collectively, millions of people making that same trade have created an institution with more concentrated voting power than anything in financial history. Not more powerful than a government, different from a government. A government can tax. A government can arrest. A government has obvious force. BlackRock has something quieter. The ability to shape how capital allocates across the entire economy. Which companies get capital? Which executives keep their jobs? Which mergers go through? Which strategies get pursued? None of this requires giving orders. It just requires being the largest voter in the room. In 1988, BlackRock didn't exist. 36 years later, it's the largest asset manager in history. Its system runs $21 trillion in risk analysis. Its votes shape decisions at every major company. Its advice guides central banks in crises. And all of this is legal, documented, public. The disturbing part isn't what's hidden. It's that it's all visible, and nobody designed it. No conspiracy, no secret meetings, just a structure that emerged from rational choices, legal frameworks, and incentives that nobody thought through to their conclusion. An ownership machine that assembled itself. And now it's running. Larry Fink started with a lesson from failure. Understand risk better than anyone else. He built that lesson into a system. The system grew until it became the way trillions of dollars see the world. And now there's a question nobody can answer yet. What happens when the machine that manages everyone's ownership is itself beyond anyone's control? You didn't vote for this system, but your retirement depends on it. Your economy runs through it. And unless something changes, something in the laws, the incentives, or the flows, it's going to keep growing. 5 mechanisms, 1 company, every major business on Earth connected to the same center of gravity. That's not a conspiracy. That's a pattern. And once you see it, you can't unsee it.